Okay, good morning, everybody. It looks like it is right at 10 o'clock Central, so we'll go ahead and get started with our quarterly provider audit webinar. And we've been doing these webinars for a few years now, and each time at the beginning of the year, the first webinar for the year, our goal is to go through the worksheet S-10 audits. So it's right at the beginning, right when the audits are starting. So that's what we're going to be doing with this one for the most part. It's going to be mainly focused on the S-10 audits. However, as we'll see in just a minute, there is one new topic that I've brought in just for a very quick discussion, and it's because of a change request that CMS issued just about a week ago. So we will get started here. We'll take a look at the agenda first of all. And that quick discussion is going to be on change request 13294, which deals with mainly focus on the instructions that are applicable for this year under audit. However, the instructions changed for fiscal years beginning 10/1/22 and after. Now that's next year's audits, but since many of you are filing those cost reports now, we wanted to just go through the topics, go through the template, just so you know what to expect. But I want to mainly do that at the end just to avoid confusing the issue with what you need to know for this year's audits. We'll go through the importance of charity care and the financial assistance policy. We'll touch on that a couple times. We'll talk about the templates themselves, the ones you'll need to be submitting, and where to find them. Nothing has changed so far for this year's audits, or nothing has changed for this year's audits, but as I mentioned, next year, the templates have changed a little bit. So we'll talk about both sides. We'll talk about how to use the file exchange, also known as the secure EDI portal, for submitting your documentation. We will talk about some special points, and some of these actually we'll already cover throughout the discussion, but it's good to touch back on those points because they are so important. Then, as I said at the very end, we'll talk about the new template for Transmittal 18 that's applicable for next year's audits, and they're the ones you're filing right now. Then we will just very quickly show some available resources. And for questions, what I wanted to mention is feel free to type into the chat area any question you have throughout the discussion. I've got that on another monitor, so I keep an eye on that. That way we can address that question where it's relevant, as opposed to having to try to remember what we talked about at the very end. So that's the agenda for today. Now, first of all, that new topic, change request 13294. This was just issued a little bit over a week ago on the 21st by CMS, and it's effective. I mean, it's effective technically March 25th, but CMS did give Max permission to start on it right now, get things going. So what I want to mention here is this particular change request is a public change request, which means you can actually go out to the website and find it. You can Google CMS change request 13294 and it'll show you the full document. Not all change requests are public, but many of them are, and this is one of them that you can see all the details of it. So there is quite a bit to this change request, and mainly it impacts cost report periods beginning in federal fiscal years 2005 through 2013, which basically means the fiscal years beginning 10/1/05. Actually, that's 10/1/04. I'm sorry, through 9/30/13 there. So those are the ones we're dealing with, and I want to mention though there is a provision for appeals and remands prior to that date. There's a little bit of verbiage on those, but the bulk of this change request is for the 2005 through 2013 fiscal years. Now this relates back to the final rule that was issued by CMS a while back dealing with the Medicare Part C days, and it also deals with a couple Supreme Court cases and obviously the lower court cases as well. Ultimately, CMS has decided that the Medicare Part C days are going to be included in the Medicare SSI ratio and not the Medicaid ratio. But the thing is, that was actually their intent since the final rule of 2005. Now, the way they went about it was what led to all the court cases, but that was their intent by the final rule. So these SSI ratios that are actually published on the website have had the Medicare Part C days, the HMO days, Medicare Advantage, whatever you want to call them, included in the SSI ratio. I'd say all along, but there were a few years where they actually thought they were going to lose the case, so they started publishing them the other way. But those were corrected in March 2012. So again, we're about 12 years now since they've been corrected on the website. Now, the reason I mention that is because if you read through that change request, they use the term republished. It almost implies that, hey, these new SSI ratios are going to be republished on the website, and it almost implies in the near future, but in reality, they've already been republished and long ago. So the point is, there's nothing new that's going to be coming out on the CMS website for the SSI ratios. They're already there. They've already included the Medicare SSI ratio. Now, what happened with this Alina issue? Way back when the Supreme Court case, the very first one, started through the process, and CMS was concerned about the outcome, they first instructed Max to stop settling everything. But pretty quickly they realized that that's going to be a big mess if we have over a decade of held cost reports. So they pretty quickly said, go ahead and settle, but immediately issue a notice of reopening to hold the position in case we needed to reopen. So we have about 3,000 cost reports that are not on hold, but the reopening is out there. The notice of reopening is out there, opening that window. And now CMS has said we need to issue a notice of revised program reimbursement. Basically settle it, but it's going to be a zero settlement. We're not supposed to just close the reopening, because when a reopening is closed, there are no appeal rights at that point. But we have to issue a revised notice of program reimbursement with what's generally going to be a zero settlement, and that reestablishes appeal rights if anybody still disagrees with the Part C treatment, and if they want to challenge that further, challenge the final rule, basically. So that's the point here. That's what this CR is mainly about, and it has a variety of buckets of different types of work, but most of them are going to be zero settlements. The main exceptions would be if some sort of mistake was made at final settlement where the wrong SSI ratio was grabbed, maybe the wrong year or the wrong provider number. Obviously, that should be a very, very small number, if any, but that could obviously lead to a regular settlement. There is one open question that we have with CMS right now about how this is going to impact anybody that had a prior SSI realignment. In other words, it was settled with a realignment. Maybe it was reopened at some point for an SSI realignment and then settled, and now we have another notice of program reimbursement out, or another notice of reopening out there. Now, our belief is that SSI realignment should stand, and we shouldn't be adjusting to I shouldn't say new, the posted SSI ratios. But the way that CR reads, it's almost implying that every single provider needs to be using what's posted on the website. Again, I disagree with that, but that's how it's written. So we wanted to get CMS's response to that to make sure that was not really their intent. So we are planning to put out a website article and a YouTube video discussing this once we get that last piece of information. But that's really what we have for that. As I said, all the cost reports that were settled, way back prior to the 15 fiscal year, prior to the 14 fiscal year, those were already notice of reopening. The notice of reopening was already issued. But CMS stuck in this verbiage in this change request, and it's a citation they've used a few times recently. Some of you may be familiar with the Hershey decision for GME, and this same citation is used in that one. Basically, and it's actually a long-standing citation, but they're saying consistent with this regulation, the final rule that retroactively adopted the policy for this dish for fiscal years before fiscal year 2014 is not a basis for reopening final settled cost reports. What that means is if we have not already reopened it before CMS issued this instruction, it cannot be reopened now. Now, again, that shouldn't be an issue because we've already reopened all of those. Now, of course, it could still be appealed if it was still timely within 180 days, but it can't actually go through a reopening. So it should be kind of a moot point because they all should have already been reopened based on earlier instructions. And with the time frame we have here is 6 months to complete for most of these, but those that are actually remands from an appeal, CMS said we have 12 months from the change request to complete those, or 6 months from the date of the remand if that happened to be issued after the change request. So that's what we have there. Now, the other important thing I want to mention, there are two big issues going on with SSI ratios. One of them is this Part C day issue. The other is the realignment requests for different years. It doesn't even have to be that range of years we're talking about. But basically, this particular CR does not impact new SSI realignment requests. We expect there will probably be a later change request discussing that, but that certainly does not roll up under this change request. And once we get more information on that one, I assume that'll be public as well. And I'm very, very, very positive it will be public at some point in the future once we get it. So again, we're going to be updating the website and having a YouTube video on this topic as well. And yeah, Kim, you bring up a very good point. If CMS does insist that the NPR be reissued with the published SSI instead of what was originally settled, the realigned SSI, that's a good point. If they go down that route, that would mean that hospitals would very likely owe money back because a provider generally wouldn't request a realignment unless it benefited them positively. I suppose they could have done it and not realize that it was going to be a negative, but that's extremely unlikely. So you're right, that would be a payback. And that's kind of what we mentioned to CMS, that our thought is that the regulation for SSI realignments, there's a provision in there that once you've requested it, you're kind of stuck with it. So I don't really see how CMS can go against that, but I'm kind of overstepping my bounds there. That's ultimately up to CMS. I would just be a bit surprised if they go that route. So hopefully more to come in the very near future. We still have plenty that we can start that have nothing to do with the realignment. So we're going to start on those first and get going. But again, we have a lot of work. And even though it seems like a zero settlement should be quick, there's a lot of overhead type work that relates to any settlement. We're talking about very old cost reports. So even just getting the cost report, reconciling it, getting all the documentation together before we actually go through the RNPR process, the revised settlement process, there is quite a bit of work there. So 6 months is going to be a very tight schedule for this. Just wanted to mention, basically don't be expecting these to be done in a week or a month or two even. We are going to use up virtually all of that 6 months. Obviously, we want to get it done as quickly as possible, but it's just a very large amount of work. So just wanted to stress that point. And now we're on to the S-10. So with the S-10, now some of these things are slides that have been there for the past few rounds of the S-10 audits, and some of the things haven't changed. So I know we got a lot of material to go through, especially that, we talked about that first topic, and then we want to get through the transmittal 18 changes at the end. So some of this stuff I'm going to be going through a little more quickly than usual, if it's not all that relevant. So for the overview and timeframes, I'm really just going to jump to the current year here. We are dealing with the federal fiscal year 2022 audits this year in 2024. And that means a cost report with a fiscal year begin from 10/1/21 to 9/30/22, and then whatever its ending happens to be. We're actually starting this process. This should read 3/1. So tomorrow, those letters are being mailed out. And we have, as in the past years, we have until December 31st of this year to completely wrap up the audits. That is a hard and fast deadline that we cannot go past. I should say the only exception might be a brand new audit that pops up in the middle of the year or close to the end of the year, and I'll explain that issue in a bit. But other than that, for the regular audits, they are due December 31st, and we actually have to wrap them up a little bit before then. So again, there's no movement. We try to be as flexible as we can throughout the year, but that is the hard, fast time frame. Now let's see, we have factor threes. So these factor threes, which is what we're using this S-10 data for, that is actually, we expect it to be used for a 3-year cycle, again, 3-year average, and it's going to be published in the, or we expect it to be published in the federal fiscal year 2026 Federal Register, which will be in April or May of 25 and final in August of 2025. Again, that's barring any potential changes CMS may make to the process, but this is generally what we've seen for the past few years. They've been on a 3-year average cycle for quite some time now. So back to the cost reports, I just mentioned the fiscal year begins, and that roughly means that we're going to be using 9/30/2022 through 8/31/2023 fiscal year ends. Now, the thing about that is most of them are 12-month cost reports, exactly a 365 or 6-day year. But if you have a change of ownership or anything like that where you've changed your fiscal year end, you might have multiple cost report periods beginning in that federal fiscal year range. In that situation, we have to select the longest one out of that group. Now, hopefully the longest one happens to be a 12-month one, but that's not a requirement. So let's say you had a 6-month and then an 8-month cost reporting period, both beginning in that federal fiscal year. We would be using the 8-month one. Even if there was a 12-month one that started shortly after, but it happened to be in the next federal fiscal year, we cannot use that. The absolute rule is that we have to have the fiscal year beginning within this range. So whatever that is, whatever the longest group is, that's the one we're going to use, and it's only one audit that we have to complete for a provider. That being said, I want to stress that that differs a little bit from the cost reporting instructions as far as the template submission requirement. So S-10 audits, even though we're using a template, there's a requirement up front when you submit a cost report that you have to submit the template with that cost report. Now this impacts especially the 10/1/22 years and forward, because they have a stringent template now that's mandated. But the point I'm trying to make here is that even if you're one of those short period cost reports, so even if you know you have a 6-month and an 8-month cost reporting period, and you know that we're not going to be using that 6-month cost reporting period for the audit, you'll still be required to submit the template with the cost report at the time of submission, even if we know we're not going to use it for audit. That's just kind of an unfortunate disconnect in the instructions at this point. Two different things, an acceptance requirement versus what we're going to end up auditing. We'll cover that piece a little bit more when we get to the cost reporting instructions. Now, this does cover all hospitals that have reported DISH. So that's, of course, the acute care hospitals and anything on E-Part A line 34. That's what we're looking for DISH. That includes sole community and Medicare dependent hospitals. No matter what, if you have anything on E-Part A line 34, it's going to be selected for the audit. There's another piece I'll talk about later. Again, a slight disconnect, but the current rule is that if you have something on E-Part A line 34 for DISH, we will have to audit that. Now, the cost reporting instructions are the same for this current year as they've been in the past few years. And that's that 3-year average is going to be used for the factor 3. So that means that every year we audit will impact multiple years, 3 years of the factor 3. So you can look at it from both perspectives. This is just a little discussion about that 3-year average. Now, I wanted to mention, I said that we're using the sole community hospitals. We still have to audit them, even in situations where the hospital specific payment exceeds the federal payment. The argument was basically that we still need to audit it. There's the possibility that that sole community hospital, may lose their status for one thing. There's a slight possibility the rates may change. There might be a mistake found or whatever the case may be. But the point is that CMS did say we must audit those SCHs again at this time. I'll show you a provision later on where we don't know. They might be changing that for the next year, but there's a little a difference in the requirement to submit the template, and I'll touch on that in just a bit. But again, that impacts next year. It doesn't impact this current year anyways. So the other thing to mention here is that if a provider has terminated, if an acute care provider has terminated from the program or even terminated the acute care number itself by converting to a critical access hospital or a long-term care, whatever the case may be, no matter when this happens, that provider will be excluded from the audit. So even if it just happens today or tomorrow or midway through the year, once we find out that the provider is terminated, the audit ceases. There's basically no need to continue the audit because that data cannot be used for that provider in the future. They're not going to be around as an acute care hospital. So that's the first thing I wanted to mention. A term provider will be excluded. And, if let's say we're starting the S-10 audits, let's say the provider is still technically in operation and we've sent out the request. If you as a provider know that that termination is underway and we just haven't received the official form from CMS, go ahead and let us know. We can't officially stop the audit, but we certainly wouldn't want to move forward too much if we know that termination is coming in the near future. So we would just kind of put a temporary pause on the audit, and then we'd expect that termination to come soon. So certainly let us know if you know something before we do, basically. Now, the other interesting thing about this is on the worksheet S-10 instructions, at the very end it says Section 1886D hospitals, which are acutes, and critical access hospitals are required to complete this worksheet. We are absolutely not using this data for an S-10 audit for a critical access hospital. The only time S-10 data was ever used for a critical access hospital was for the EHR incentive payments, which have been gone for a number of years now. So the requirement still stands for you to complete the worksheet until CMS removes this, but you do not have to submit a template. We are not going to be auditing any of that. We don't know. There might be some other use CMS has behind the scenes for this data for cause. We just don't know that, but we only know we're not auditing a critical access hospital for this. So that's the piece I wanted to mention there. And let's see, the providers that have submitted amended cost reports. So if you didn't have DISH initially, but now you've submitted an amended cost report to add DISH, maybe it revised an SSI ratio, maybe it added some Medicaid days, whatever the case may be, then now this is subject to the S-10 audits. And this is that exception I mentioned earlier where everything's due by 12/31. But if all of a sudden on December 1st we get an amended cost report, there's no way we're going to be able to get an audit done in 1 month. So that's a situation where we have to go to CMS, let them know the situation, and we'll still have to do it as quickly as we can, but it very likely won't be by 12/31. So that's the thing about that. If you know you're going to be amending the cost report, the sooner the better for both parties. We don't want to rush a provider. We don't want to be rushed with the audit. So the sooner we can get that started, or at least become aware of it, the better. Now I wanted to talk a little bit about the various factors. The factor 1, 2, and 3 that are used to calculate the DISH uncompensated care payment. So the factor one, and for this to make sense, let's go back to traditional dish. Before the UCP started, I think that was back in 13. Before that started, you just had the regular dish payment, what's called the empirically justified dish payment. And that was based on the Medicaid ratio and the SSI ratio, and that was it. But in 13, they started this uncompensated care payment, and to fund it, they carved out 75% of the traditional dish payments. So that set aside a pool that was then going to be apportioned out based on these other factors. So every year, a new factor one is calculated by taking 75% of what would have otherwise been the dish payments. Now, of course, that gets updated each year, and that's in the Federal Register. Factor two, however, is a reduction factor to that based on an expected decrease in the number of uninsured patients due to different insurance provisions, just different things. But the point here is that that factor one is going to be reduced, or should be reduced each year, to ultimately give us the pool of money that's available for the uncompensated care payment. So factors one and two, we're not auditing those. That's data CMS gets, and they publish in the Federal Register. Factor three is what the S-10 audit is all about. And our S-10 data that we're looking at is what's used to calculate a hospital's specific share of this pool, this overall pool. Relative share, I guess I should say, relative to the entire total population of providers. So factor one is published in the Federal Register. This is an excerpt from the fiscal year 24 Federal Register, and it's 75% of this amount. So in this case, for 2024, it's 75% of 13.35 million. Factor two, I have both the proposed and finalized, and these are both 24. I have a bit of a typo there. It was proposed to be 65.71%, and that would have brought the .7 down to 5.9. And again, each hospital gets a share of that based on their factor three that CMS has used an average of 3 years data to calculate. Now, compared to last year, so let's take a look here. The final for this upcoming, or I'm sorry, the final for 2024 that we're already in was 5.9 billion. Last year it was 6.8 billion. So that's a pretty big drop there year over year. And again, each hospital gets their share. So that's all, it all fluctuates year after year depending on the dish payment data, the S-10 data, all of that. So with that, let me take a look at the questions. Any update on the nursing allied health provisions to pay back funds previously recouped? Yeah, that's actually, it's due by the 19th. So those are all being wrapped up. So every MAC has to have those completed by the 19th. So you should see those very, very soon now. And let's see, on to the S-10 audits, the lessons learned. So every year we try to bring in a lessons learned discussion of, what have we found from the audit side, from the provider side, what have we heard that would make this next cycle a little bit better? So one of the things that came up was just the format of submitted listings. And some of it in the past was basically the number of requested data fields. Now this has changed for 10.1.22 and on. There are actually some additional ones, but they've also cleaned up and removed some ones that people, a lot of people didn't think were relevant, and they really weren't relevant in the past. So I'll mention that when we get to the templates. But that was always a concern. Things like gender, social security number, date of birth, that weren't really all that necessary. Missing data elements. This is an issue when we get a listing that just doesn't have the data elements we need, some of the ones we truly need to do the audit. And that becomes a big concern because if we cannot get the data up front, as we'll see when we talk about it a little bit later, if we can't get good data up front, then we can't do a quick scan to clean out the obvious errors, and we're left with detailed sampling, detailed testing and sampling and extrapolation, which could have a much larger effect due to any of those errors that were found. So it's much better to get a clean listing up front with all the data elements, and then we can eliminate the pieces that don't belong. And then the sampling is just for those items that can't be, they aren't obvious errors. You have to be looking at the documentation to see that error. Size of resulting files. So there were a few things that happened with this. One of them was the old listings, years ago used to require a breakout by revenue code, and you could have some Excel spreadsheets that literally it exceeded the max size of Excel, the row count. So you'd have to have multiple Excel spreadsheets just to fit all of your data into it. And obviously, when you tried to email those, that could be a problem there. Now, we've mitigated some of that problem with the use of that secure EDI portal that we talked about. There's a 2 gigabyte size limit for that, as we'll see. So that mitigates a heck of a lot of the size issues. But there was still just the concern about the Excel spreadsheet. The good news is that CMS made a change a couple of years ago, and they basically said the only reason we ever had the revenue code breakout to begin with was to help us ensure that no professional or physician services were included. That's why we needed the revenue codes, so we could easily find those. But if a provider can attest that their provider or their physician and professional services are in a completely different system and there's no chance of commingling, then that breakout by revenue code is no longer needed. I will also say that come 10/1/22, the ones you're currently submitting with your cost reports, the revenue code is completely gone from the listing altogether. So the point is that's been somewhat mitigated. We also had a concern about the use of the term query logic. This is something that showed up in the audit programs from CMS initially. So we used that term. We requested query logic. And what we got in some cases was actually true query logic programming scripts, database programming scripts, which is not what we were looking for. We're looking for more of a narrative about how you searched your systems to ensure that you only included write-offs within this period. How did you search your system to ensure you carved out courtesy discounts, basically things like that. So we actually have built what's called the query logic questionnaire, and it goes through those narratives we're looking for. So you just need to respond to each of those questions with a narrative, and that takes care of that query logic. And we'll see that later. Our thought is that that serves as both a training to providers while you're trying to search your system so you know what's allowed and what's not allowed, but it also meets the requirement that CMS has with their audits, so we can document that we've done the review, we've provided the assurance. Timeline obstacles. The same thing comes up with wage index and obviously these S-10 audits, because there's a very stringent time frame that these have to be completed in, and there's not really a whole lot of room to budge. The earliest start is definitely the best. We wrapped up the last cycle 12/31. Now what we've done each year is we've tried to build in about a 2-month kind of gap, if you will, for both providers and Max, the auditors, because the same auditors that do the S-10 audits are also the ones that do what we call the field audits, the more complex types of audits and desk reviews. So they take that 2-month cycle to kind of catch up on some of the due dates for some of those things, and gives the providers a breather as well. And then we start the process around March 1st. Another part of that reason is that some of the fiscal years aren't even in-house by January 1st or February. In fact, some of them we have a handful that are still not in even right now. They should be here pretty soon. So for that reason, we tend to start March 1st. What we are doing this year, instead of giving just a 30-day due date, we're giving a 45-day time frame, so it's due by April 15th to submit the documentation. And then if extensions are needed, if there are extenuating circumstances, you can certainly work with your auditor to request that as well. So the earliest start is the best, but they are still due by 12/31. We know there have been some concerns about the later in the year, how it overlaps with wage index. Depending on your fiscal year, it overlaps with due dates for some cost report filings. But the reality of it is there's not a whole lot that can be done. We certainly couldn't start any earlier than January. And even then, why start that early? So we're only losing 2 months there, and these have to be done by December 31st. So we do try to be as flexible as we can throughout the year, but we have to keep that year-end deadline in mind as well. So any of the due dates, if we establish a due date, again, if you have something coming up, you can work with the auditor to see if you can extend that due date. Just work with them. I mentioned this earlier, the upfront analysis versus the back-end extrapolation. In a perfect world, we'd be able to identify all of those obvious errors up front. And by obvious errors, I'm talking about things that are obviously not written off in this year. We can find that easily. Things that maybe had a transaction code that's not even charity care. Maybe you put a bad debt on the charity care listing or vice versa, or maybe you put a courtesy discount on there. Those can be carved out quickly. With the revenue code, we could have carved out the professional fees. That's, again, was the purpose of that. So those obvious types of errors, or duplicates, true duplicates, where the exact same claim for the full amount was reported twice, that's of course not allowable. And I want to stress there's a different situation where you have kind of partial duplicates, where maybe the claim was written off, maybe 50% of it was written off for charity care at one point, and the other half of it was written off either for charity care again, or maybe for bad debt later on that year or in another year altogether. There's nothing wrong with that, but we want to make sure that the total amount of charges for that entire claim weren't exceeded somewhere. And that'll make a little more sense when we get to the template. Basically, we know what amount should be left over for charity care or bad debt, and we want to make sure a provider hasn't reported more than that allowable amount. That would be considered a duplicate. So for us to be able to do this upfront analysis, of course, we have to have a proper listing with all the data elements, and we have to be able to understand that query logic that the provider used to develop their data to begin with. So as we're reading through the query logic questionnaire, we may see certain things, certain responses that lead us to believe, well, hey, there might have been an error here with how this was selected. So we may come back with further questions about that piece. So again, the query logic is supposed to benefit both sides. Providers will know exactly what they're supposed to be grabbing, and auditors will know how they're supposed to be reviewing that particular provider's data. Another issue that has come up over time was inconsistent sampling amongst MACs, and whether it be methodology, different sample sizes, when or how they extrapolated, what type of documentation was selected. This has actually been brought up to CMS, and it went through, I think, even the Federal Register comments. But the end result is that CMS doesn't want to mandate one standard sample that would work for every single type of audit, because the reality is they are different audits. There are different scopes. For whatever reason, the dollar amount or the risk was different from one audit to the next. So the CMS wants the auditor to be able to use their judgment to determine what methodology, what sample size best fits that particular risk of an audit. So that's kind of the response to that piece. Communication breakdowns. This is one that it's certainly a big problem when it happens, but it's also one of the easiest problems to fix. The first side was just the lack of identifying proper points of contact, either what auditors to contact, Maybe it changed throughout the year, or maybe it wasn't clearly communicated, but also on the provider side, if something changed there. So what we do is actually keep a log, and we carry over prior year contacts from year to year until we're told otherwise that there's a new contact to deal with. Now, I will say here that the initial S-10 audit letters, we are required to send those out to the what we call the STAR contacts. It's the STAR system, and those are the authorized officials that are on your provider enrollment form, your CMS 855. So we're required to send it out there, that initial letter, but the later communication can go back and forth between the auditor and whatever contact you delegate it to. So that's the thing there. We know prior year contacts, and hopefully those still work, but if they don't, just let us know as soon as possible so we can update our log, because that's who when the auditor reaches out to you initially, which, by the way, that'll be happening in the next week or two. The letters are going out tomorrow, and it'll take a couple days, 2 or 3 days to get there or whatever. And then that letter will tell you that the auditor will be reaching out to you through the secure EDI or the file exchange portal to basically establish the connection that allows you to send them information. If it's the very first time you've used the system, it'll also set up your account, it'll set up your password. But the point with that system, as we'll see later, is that any auditor you need to contact must have already reached out to you to establish the link. That's a built-in security protocol, because again, it is supposed to be for possibly sensitive data. It's a security portal for that sensitive data. So the other thing about this, insufficient time to review or respond to adjustments. We try to work with providers and give the 2 weeks to review those adjustments. Now, there might be situations where maybe half the adjustments are sent early on in the audit, and then the other half are sent after that next piece is reviewed. But most of the time, it's going to be kind of a complete set of adjustments sent out. But that's our goal there. Education and training opportunities, which of course would include this very webinar. The idea here is through our webinars, through our YouTube videos, and through our website, we're trying to provide the education on the different types of errors that we've seen and different, of course, any changes that come up, but we try to communicate that. In fact, even though this first quarterly webinar of the year is S-10 centric, we talk about S-10 in every single webinar. It's one of our first topics that we just give you a quick overview of what's happening, because keep in mind, this is largely an entire year cycle from, again, March to all the way to December. So it's really always on certainly the auditors' minds and a lot of providers, I'm assuming, those that deal with that. So let's see, we have another question here. Any idea when the fiscal year 22 SSIs will be published? I would expect it very soon, since we're just now heading into March. I would be very surprised if it goes more than a month after that. So sooner rather than later, certainly. And what we'll do, as we take the SSIs and we publish them in our document control system for providers, or I'm sorry, for our auditors to use. But we also have to update FIS, the claims processing system, with those SSI ratios very quickly thereafter. I think they usually give us like 30 days, but we usually get them done even more quickly than that. We've got an automated tool that allows us to update FIS with that data pretty quickly. So sooner rather than later, but I don't have an exact date. So good question. And let's see, cost reporting question or instructions. So I want to stress here that when we see the different cost reporting instructions, there are different time frames. So we have those that were prior to 10.1.16, which again, we haven't been using for a while. Those are the old original ones. But then we have from 16 all the way through 2022 or 21, I should say. That's what we're in right now. But then the instructions did change 10.1.22 and on. So I'm not going to talk about the pre-2016 because I want to avoid confusing the issue they're not relevant anymore. But I will at the very end talk about the 21 or 2022 Federal Register, 2022 instructions, I should say. So I do want to open that up right now and kind of show you what we have in this case. So the S-10. Whoops. Yeah, maybe. Yeah, I need to close that out and open it back up again in a second here. Yep, we'll come back to that in a second here. HFS locked up on me. Yeah. Get out of that one. We'll come back to that in a second. I'll let it start opening up again. Just 1 second here. I don't know what did happen. Yeah, anyways, we'll come back to that. But I'm going to show you the instructions, and actually I have a few screenshots anyways with that, so that'll clarify it. But the point is, make sure to use the proper instructions when you're dealing with that, the ones that apply to your particular year. So the Transmittal 18 that I mentioned, that revised the design of the cost reporting instructions for 10-122 and on. Just as a quick note, that was Transmittal 18. We're currently on Transmittal 21, so that's been around for a little while. The big change there are some good and some bad with the instruction changes. The big good thing, the big positive thing is that it clearly organized the instructions. But of course, since we have a lot more data there now, because there are now 3 ranges of years to deal with. That's the confusing piece. But I do want to mention that point about the requirement to submit these templates that CMS has now developed for 10-118 and after fiscal year begins. This has actually been in place for a while, even for the old templates. The old instruction was basically you had to have some template. There was not a mandated design for the template, but you had to have something that supported the amount you reported. Now, of course, by the time of the S-10 audit, we have to have a specific template with all these data elements. But at the time of submission, technically, you just needed to have some sort of spreadsheet with patient level data that supported your total amount. Now, 10-122 and after, there's a very stringent template that must be used now. So that's the difference. Now let me open up this cost reporting instructions that I was getting to. And we'll look at S-10. Oops, let me get back to that here. So the S-10 cost reporting instructions, there are a couple things I want to point out here. This was all changed in T18, as I said. If you look at S-10, there are actually 3 different lines of information. The first one is just S-10 in general, which gives you an overview of the S-10 process. Now notice, before we get further, I want to stress this. It says effective for cost reporting periods beginning on or after 10-122. Worksheet S-10 is part 1 and part 2. Now, part 1. Now, we don't know exactly what CMS's plans are for the future with that part 2, but what I can tell you is for right now, we are only auditing part 1 data. In other words, the entire hospital complex. And that'll apply to next year as well. I'm pretty certain because they have not changed the template requirements. So I'll get back to that here in just a second. I jumped ahead a little bit. But part 1, these are the instructions that we're concerned with at this point. And my point about the time frames, if you look at line 20, you'll see here they have a 10-116 set of instructions. It's labeled as A. B is your 10-116 through 10-1 or through 9/30/22 actually. A was pre 10-116. This is the middle range. And then C is for 10-122 and after. Again, they've kind of clarified the things. They've used bullet points instead of large paragraph now. That makes it easier to read. We're going to go through these, but I just want to point out that there are different time frames that you have to make sure to grab. In my opinion, it would have been a little better if they kind of bolded this to really set it aside so you don't just accidentally get into that section, but that's just my preference there. So that's part one. That is what we're going to be dealing with. That's what your templates currently should be for. The odd thing is that if you go to part two, which is not what we're looking at, this is not what we're concerned with as far as auditing. But if you go down to part two, that is for some reason where they stuck the templates, the new templates. So that part's confusing at first, but if you read through it, they've at least clarified it in the instruction. It says that this template is only for part one, S-10 part one. In fact, that was a very recent change. As you can see, it's in red. So there were obviously questions. Why is this template in part two if we're auditing part one? This is their way to correct that. So the point I wanted to make here is, again, these are the templates for 10-1-22 and after. There is no mandated template as far as what it looks like for prior to 10-1-22, other than at the time of S-10 audit. But when you submit the cost report for 10-1-22 and after, you have to have this template. That's the point. We're going to discuss the different columns of that template, and that's later on when we go through the templates themselves. There is one other piece that I alluded to earlier, and now I'm going to wrap up. I said that sole community hospitals were still required to audit them, and I said that we don't know what the future holds for that, whether CMS plans on changing it. However, if you read this instruction for both 3B and 3C, it says if a sole community hospital is eligible to receive addition adjustment, but E-Part A line 48, which is basically your federal, or I'm sorry, yeah, it's your hospital specific payments. If they're greater than line 47, your federal payments do not complete this listing. So you don't need to submit it at the time of the cost report submission. But obviously, if it's the other way around, you do need to submit it. So it's possible this might be a hint that we might not need to audit these next year, because again, this is 10-1-22 and after, but I wouldn't take that 100% because there is still the disconnect between what's required at the time of submission versus what's required at the S-10 audit. It's possible they still require us to audit S-10 next year for SCHs, and at that point, we would just need a listing at that time. You just wouldn't have to submit it at the time of cost report submission. So I don't know for sure what the future holds for that, but you don't need to submit it at the time of the cost report. And let's see, a couple questions here. So yeah, you make a good point about how those SSI ratios will affect your 6/30/23 cost report periods. But keep in mind, though, that's actually been the case quite a bit in the past, where by the time you submit the cost report, you don't have the SSI ratio. That's just kind of the nature of it for some fiscal year ends. When we do the tentative settlement and certainly the final settlement, we use the proper SSI ratio at that time. So in a perfect world, everything would be available by the time you submit your cost report, but that's really never been that way. There's always a few fiscal year ends that are just don't have the SSI ratio by that time. And Jen, you had a question. Will you be able to have one entrance conference for all providers at one time? So what you'd want to do for that is work with your auditor, and if you send in a request like that, that can be escalated up to the manager, and they should be able to work with that, barring any unusual circumstances there. But that would, if it's a group of providers, if it's a chain, that could very well be possible to get all the information at once. And let's see, those instructions. So if you use, and all hospitals should use HFS now, but I understand that you might send your stuff out to cost report preparers, so you may not internally actually have access to HFS. But if you go out to the CMS website, in fact, I'll show you a link we have as well. But if you go to the CMS website, cms.gov, you can find all of the cost reporting instructions there as well. It's under the CMS publication 15-2. And for the hospital, it would be chapter 40. And that's where you'll find all of the instructions for that. But on that note, I'm kind of jumping a little bit ahead, but let me show you our own internal website here. And we have, this is a, by the way, the website has changed. It used to be WPSGHA.com. Now it's med.WPSGHA.com. And if you go out here, there's a search bar still, so you can find it that way. But if you go to the topic center, select cost report audit, which is where all the audit related information would be, of course. Select whatever provider group you want, accept the AMA license. And if you go down here to cost reports, we have a link, cost report documentation requirements and templates. This is specifically for all those templates. Now this is for bad debt, dish, S-10, everything. But if you look here, it says, it's close to the top. It says you can access the CMS version of these forms from this link, and it actually takes you directly to CMS's website where they have those various templates down here, all the different templates and the instructions for them. So they're also there. You don't necessarily need to go to the cost report to find them for the templates. The instructions for the template, but you would still need to go to the cost report to find just the S-10 instructions in general. So we have that. And that's a very good point. We always try to update the website, our website, to make sure it has relevant information. What I might do in that same place is put a link directly to CMS's policy website where you can find the cost reporting instructions. I haven't done that before, but I might go ahead and do that just to give you another place to find it. And let's see here. Let's go back here and see we have some more questions. Yeah, very good point. A provider may not have qualified for DISH at the time they filed, but then the new SSI ratio may bring them into eligibility. And you're exactly right. That or the Medicaid days, either one could bring you into eligibility. So that's one of those situations where if you ended up filing an amended cost report to report DISH, then we'd have to obviously S-10 audit that. Or at the time of tentative settlement or final settlement, if we, well, maybe not final settlement, but tentative settlement, if we know that's a DISH provider, then we would be able to add that to the S-10 audit at that point as well. And let's see, is this template required for all hospital or only DISH hospitals? And that's a good point. So it's, except for those that are SCH, as it said in that instruction, it's basically only applicable to those that had DISH reported. And again, except for those SCH providers. So the MECREF edits that you're referring to, when you submit your cost reports, they'll know whether this applies or not. And they'll be looking for comparison with the S-10 data and that template. We'll talk a little bit more about those edits later on as well, because there are a few questions that have come up about just those edits and how stringent they are. So I said that some of those changes were being made effective 10/1/22. That's not going to impact our current year's audits. That's for next year. And we talked about the part 1 and part 2. We're only doing a template for part 1. This is just another screenshot of those different ranges of time. We talked about this already. So now let's go into the actual data that we are reviewing, the data that CMS is using. So if you go to worksheet S-10, line 30 is ultimately what CMS is concerned with. And that is basically the sum of your charity care cost and the bad debt cost, which we'll define in just a bit. But notice that there is actually a line 31 after that. it takes line 30 plus information all the way from back on line 19. We understand some of the Medicaid programs might be using that data for one reason or another, but Medicare does not use it for anything. We only use line 30. Now, line 30, as I said, it's the combination of line 23, which is the cost of charity care, and line 29, which is the cost of non-Medicare and non-reimbursable Medicare bad debt expense. Unfortunately, they like to use that word expense, which is actually not correct, but basically it's the cost of the total non-Medicare patients bad debts plus the portion of the Medicare bad debts that Medicare hasn't already reimbursed for. So in other words, the 35% that's not already reimbursed on E-Part A, E-Part B, wherever else. We'll talk more about that detailed breakdown of these two in just a bit. Now, we don't edit those lines specifically. Those are all calculated lines. We have control over line 20. That's what can be edited and adjusted. We have column 1 and column 2, and then, of course, column 3 is the sum. Now, line 20 is your charity care charges, uninsured discounts. For the uninsured patients, that makes perfect sense. It's truly a charge. But for the insured patients on column 2, it's generally a co-insurance deductible or copay that's included there. I'll mention the exception in just a bit, but I do want to point out one thing here. In this example, in column 1, we had $1.9 million of charges, charity care charges, but then the underlying cost of those charges is $684,000. That reduction is basically way back on line 1. So let me just open that up and show you here. At the top of S-10, you have line 1, which is a cost to charge ratio. Now, this is just a blank shell. I didn't want to have any providers data out here. So it's a blank shell, but there would be a cost to charge ratio here. That's what is used to reduce the charge down to the cost, basically eliminating any profit margin or markup because CMS reimburses this based on cost. Or I shouldn't say they reimburse it based on cost. They use the cost data to determine the UCP payment down the road. So we have that cost, but notice for column 2 in this example, there was no reduction. In most cases, there's not going to be a change because if these are co-insurance deductible or copay, they're not charged, so there's nothing to reduce by a cost to charge ratio. That's, again, in most cases, but what I want to mention here is that the way the instructions are written for the insured patients, it's an odd provision, the way the mechanism that CMS used, but there are certain situations, there's one situation specifically where you have a Medicaid program and a patient that's Medicaid eligible, and if they've exceeded the length of stay limit throughout their claim, so some portion of that claim is no longer covered, what CMS requires is that the non-covered portion of that otherwise insured patient, the charge related to that gets lumped in with the regular copay, co-insurance, all of that in column 2. Now, the problem with that is that every charge amount needs to be subjected to that cost to charge ratio, whereas the rest of it in column 2 would not be. So that's what this line 25 down here is all about. If you have some portion of column 2, line 20, that was a charge amount, you need to tell the system how much of that was charges down in line 25. The point I want to stress is that it must be in both places. The charge must be called out separately here, but it also must be part of this total amount here. And that tells the system how much to reduce down by the cost to charge ratio. In that case, line 21 of column 2 would no longer match line 20. It'd be slightly smaller. Not as big of a drop as column 1, because probably just a small amount of column 2 was that non-covered portion. So we'll get into that here in just a bit. I'll show you the other side of that example when it actually does happen. Now, line 26 is total bad debt. They use the word expense here, which is actually not right, but they're saying total bad debt expense for the entire hospital complex. So let's focus on total first. Total here means both Medicare and non-Medicare bad debts, but of course it needs to be net of recoveries. If you've already recovered a portion of that bad debt in a later year generally, then it has to be net of those recoveries. So that's the first rule. The second rule, though, is that it has to be a bad debt that's written off on your general ledger this period, during this cost reporting period, regardless of whether it met all the requirements for Medicare write-off on E-Part A. Now, what I want to stress here is that line 26, it's a write-off. It's not an expense. Under GAAP, under generally accepted accounting principles, bad debt expense is an estimate of future bad debt write-offs. That's how the expense works. We want actual write-offs when they happen. So there's a timing disconnect and possibly even an amount disconnect between an estimate and the future eventual write-offs. So that's why expense is wrong. It's a bad debt write-off for the entire hospital complex. Fortunately, if you look at the cost reporting instructions, it does tell you that it must be a write-off. It's just a disconnect in the verbiage that's wrong. The point, though, I want to make is this is GAAP. It's when it's written off basically for GAAP or financial statement purposes. Medicare has additional requirements before a bad debt can be written off for Medicare on E-Part A. That does not impact what you do on line 26. So in a situation where you have a bad debt that was at the collection agency, you did write it off in your accounts receivable ledger, but now it's at the collection agency. It might be there for a year or more. We cannot write it off on the Medicare side, on E-Part A, for example, until it comes back from the collection agency. It's still an allowable bad debt write-off for 26 now, and then later on it'll show up on E-Part A in another year. The problem with that, it's another one of those disconnects, is that line 27 and 27.01, they pull the amounts specifically from E-Part A, E-Part B, etc., to identify how much of line 26 they believe are Medicare bad debts. And I just said there is potentially a disconnect right off the bat. 27.01 is the total bad debt, and then 27 is the amount that Medicare actually paid for, the 65%. So the difference between those two would be the 35% that Medicare will not pay for. So out of that, these three lines, the system can get an idea how much of this line 26 is supposed to be non-Medicare bad debt. And then they can also take in, well, let's do that first. 28 is basically non-Medicare bad debt. It's the portion of line 26 that was not Medicare, or at least it doesn't appear to be Medicare, let's say. So they take that amount, and then line 29 says, okay, let's take this line 28. All of that non-Medicare bad debt is subject to the cost to charge ratio, the same cost to charge ratio we talked about earlier. So that's reduced, plus the 35% Medicare did not pay is added in. That's what line 29 is all about. And then, of course, that gets added with charity care to get line 30. Now, I just mentioned there's that disconnect, that even though the system thinks it knows how much of this line 26 is Medicare, it may not be right. It may have been Medicare from an earlier year or for a later year. So there is going to be that disconnect, and it's just the way the instructions are. But the thought is over a 2-year period, generally a 2-year period, it should wash out. You might have a bad debt from 1 year that was reported in 26, and then it's reported on E-Part A as Medicare the next year. So unfortunately, that's just the way the logic is for this. There's no way to reconcile all the different instructions into one clean piece. And that's because line 26 is supposed to be total bad debt write-offs on your financial statements. I shouldn't say on your financial statements, total bad debt write-offs in your ledger. And the reason I say that is that write-offs are actually not a component of your income statement anywhere. It's the bad debt estimated expense that's a component of your income statement. So I really actually just went through all of this. Here's the narrative for it. So now we need to talk about what actually needs to be reported. Here are the instructions for line 20, but we're going to talk through the different columns and lines. Some of this I went through, but we'll dig into more detail here. Column 1, as I said, is for uninsured charity care, and it's mainly for fully uninsured patients. You know, when you think of uninsured, you say, hey, they have absolutely no insurance whatsoever, but that's actually not always the case. You could have a patient that technically has insurance, but the insurance doesn't cover them at that hospital because they don't have a contractual relationship with that provider. So that could happen, and it's unpaid, it's uncovered for sure, non-covered. So it does get included in column 1, but it only is allowed if your charity care policy specifically references that being allowable. CMS has really left a lot of the S-10 rules up to what a provider's policy allows. There are certain things that are just flat out not allowed no matter what, but most of the things, it's all about what's in your policy. You know, it can also include non-covered charges for Medicaid, but again, only if your policy allows it. I want to stress, though, this non-covered charge for Medicaid is different than the whole exceeding length of stay limit. Yes, that's non-covered as well, but for a different reason. Non-covered up here that I'm talking about is it's maybe that service isn't covered for whatever reason. Everything else might be, but that service is not. The Medicaid length of stay limit has that special treatment, unfortunately. Now, again, this is all about the portion written off during the cost reporting period, written off in your books to charity care based on your charity care policy. Just a little blurb about how the pre-2016 worked. And again, I don't want to confuse the issue. It's definitely different, but for the past several years, we've been dealing with write-offs this year. Again, only the portion of that claim that's written off to charity care. No matter what your policy says, CMS has mandated that you cannot allow courtesy discounts or any amounts for physician or professional services. Those are just absolutely banned from this. A courtesy discount, by the way, it's for a specific group of patients of patients, individuals. A lot of times it's the clergy that's included. You might have some sort of employee type courtesy discount. Those types of things have nothing to do with financial status, and therefore they're not part of the charity care provision. For the column 1, we're talking uninsured, so you could include a self-pay or uninsured discount as long as your policy allows it. Now, I'm going to stress this a couple times because it's so important. If you wrote something off to charity care, and if for some reason the patient still came back in that year and paid against that amount, and you accepted the amount, then both of those things should be removed from the books. We don't want to see the charity care. We don't want to see the payment in that same year. They both should be removed. Now, I want to stress, though, I have an example later where only part of the claim was written off to charity care. The other part, the patient was still expected to pay. Payments against their actual liability are perfectly fine. That shouldn't show up anywhere. I take it back. It shouldn't show up on S-10 line 20 or line 22. It'll show up in the templates, as we'll get to in a bit, but it's not something you report as a payment offset against charity care because it's an offset against the amount they already owed. The portion that's charity care approved, if they make a payment against that, that's what we're concerned with here. Now, the other thing in column 1, if you have a claim that had exhausted benefits, now other than that exceeding length of stay limit, technically that's an exhaustion of benefits as well, but it's treated separately for some really unknown reason. I never been able to get an answer why. they felt that was so different. But in any case, if it's due to not an exhaustion of benefits where part of the claim is non-covered, part of the claim is covered, for those situations, you'll split the claim. The uninsured column will report the charges for the non-covered portion, and column 2 for insured will support the coinsurance deductible amount for the other part of the claim. Now, of course, we want to make sure they're reported properly, so you need to have adequate documentation to show how you decided on that split. But again, I just need to stress that you do not split the ones that had the Medicaid length of stay limit. Both parts of that claim, covered and non-covered, need to show up in column 2, which we'll see in a bit. So now we'll move over to column 2. And again, it's generally for fully insured patients, fully covered patients. We only want to see the coinsurance deductible or copay. Now, I do want to stress here, there was some confusion up front about whether copays were actually allowed, because they technically are a little bit different than a coinsurance. It's an amount versus a percentage often. The original instructions did not have copay. The original audit instructions specifically told us we only could include coinsurance and deductible. That's been years ago. CMS finally clarified that yes, copay is allowed as well, fortunately. So those are the amounts we generally want to see in column 2. But again, if you have that Medicaid exceeding the length of stay limit, that in this column 2 insured section. Again, that's still only if your charity care policy specifies that. Otherwise, it's not allowable no matter what. Just like with the column 1, this is charity care written off during this cost reporting period. And again, if you have payments against a true charity care amount in that same year, both the charity care and the payment should be removed. We don't want to see it. Here's just a brief discussion of how they finally added copayment into some of the instructions. It was partially updated. Unfortunately, there are still places in the instructions where it just says deductible and coinsurance, but regardless, that's been pretty much clarified. All 3 are allowed. As before, we cannot include courtesy discounts or physician professional services. Now, here's the other thing to note about column 2. It's insured, and Medicare is an insurance, so one might think that, hey, it's perfectly fine for the Medicare charity care to be included here. The problem is Medicare quote unquote charity care is also referred to as Medicare indigent bad debts. So we've already got a provision to allow Medicare indigent bad debts, which again are sometimes interchangeably used as Medicare charity care bad debts. I try to keep that split between the verbiage for this very reason, to avoid confusion. Indigent bad debts following that exact same charity care policy are already allowed on E-Part A, E-Part B with bad debt reimbursement. So we cannot allow it here as well. That would be a double type reimbursement. So the only time you would truly expect to see a Medicare patient claim being included here is if there's no way it could have been included as a Medicare bad debt. For example, if you didn't meet certain Medicare bad debt requirements that permanently tainted that bad debt, timely billing would be a good example. If you didn't timely bill for that, it's never going to be allowed as a Medicare bad debt. So you could put it here as charity care instead. There might be other situations where it just didn't qualify. Yesterday, one of the things that was brought up was a Medicare fee schedule bad debt. Fee schedule is never allowed as Medicare bad debt. That's a ban, if you will. So that's not allowed there. It could be allowed here as long as it's not professional or physician services. So it could be a different type of fee schedule, like a therapy, that's allowable. It's just not allowable as Medicare bad debt. That could certainly show up here without any problem. So whenever we see a Medicare patient in the insured listing, it's a big red flag, but it doesn't mean it's not allowable. It just means we need to scrutinize it. So here are the pre-T18 templates, the ones we're using today. I want to go through these just briefly to talk about them. The first column is the insurance status. Is it insured or uninsured? Which columns are going to go in? We need to know about the insurance payers. Currently, we need to know about the transaction code. Like, is it a charity care? Was it a courtesy discount? Was it a bad debt? That helps us to weed out the things that are not really charity care. Patient identification number, basically all the patient information, which again, some of this is being excluded from the new templates. Important detail, revenue code total charges for the claim, or just total charges for the claim. The idea here is that we're going to take this total charges and identify where those charges went, who paid for those charges, or were they adjusted. Now notice right in the middle of it, there's a write-off date as well. It just kind of gets in the way there, but of course it's important, just bad placement. So now we look at what we call the charge components. Total patient payments for services provided. Now I want to stress, this is what I was talking about earlier. This is all of the payments, whether it was for a charity care amount, whether it was for the rest of the claim. This is all of the payments that you've accepted. If you returned a payment, which some providers do when it was written off to charity care, then of course it's gone. You've returned it. But if you accepted the payment, we need to see this regardless of when the payment was made. This is the history of the claim for this patient payment. Same thing with the third-party payments like insurance companies. This is the important amount. It's the charity contractual amount. This is what we're actually looking for line 20. And then they also have other contractual amounts, basically things that were not allowed. Insurance write-offs, courtesy discounts, anything like that that we could not allow. By the way, there's an informational column for that length of stay limit for Medicaid. That tells us how much of this needs to be reported on line 25. But the point I'm trying to make here is that we take this total charges, we subtract out the patient payments, the third-party payments, the other non-allowable contractuals, and we should be able to reasonably back into charity care amount. Now, it may not be perfect, because there may be situations where the patient still owes something. They haven't paid it yet, but it hasn't been written off. But in no case can these components exceed the total charges. That's really what this reconciliation is all for, to help us make sure that the charity care amount was not more than it should have reasonably been. So now I want to mention that these are the pre-10/1/22 fiscal year begin templates. They're the ones we're using today. We're going to also talk about the T18 in a bit. Largely, they follow the same mechanism, but there's a little more clarity to the new templates. So we'll get at there. And yeah, Alan, to answer your question, this one that I'm showing right now, it's the current template for pre-10/1/22. We'll look at the other one later on. So payments. Line 22 is where the payments are to be recorded, but I want to stress again, I know I've overused that term, but this line 22 should be pretty minimal because it's only those payments that were made for a charity care claim that was written off in a prior year, and the patient still paid against it this year, and you accepted the payment. So it's kind of like a recovery. But again, there are two reasons why this might not show up. First of all, if the payment is made for a non-charity care portion of it, then it's not going to show up on line 22. But also, if it was made the same year as the charity care write-off, we just said earlier how both parts should just be excluded altogether. So line 22 is pretty minimal. We've heard from a lot of providers that have policies in place where they don't even accept these payments if it's already been written off for charity care. They refund it back to the patient immediately. So in that situation, line 22 would be zero. But regardless, it should be pretty minimal because those things just don't generally happen where a patient actually makes a payment against a charity care charge. Not saying it's unheard of, it definitely happens, but it shouldn't be the majority of your claims. Otherwise, why did it get approved for charity care to begin with? That's the thought. So line 22, for whatever amount is there, that does offset the payment, or that does offset the allowable charity care. Here's an example of that. If a patient had a $1,000 charge in 2021 and 75% of it was approved for charity care, the patient only owes the remaining $250. $750 is charity care. If that patient paid up to $250, then hey, that's their normal liability. We're not going to be reporting anything in line 22. If the patient paid more than $250, let's say they paid $850 in 2021, again, the first 250 of it is not charity care, so we're not concerned with it. The next 600 was technically against a charity care amount, but it's the same year, so we would remove both the charity care of 600 and we would exclude the payment from line 22, and it would be a wash to zero. Now there's still 150 of that claim left because remember, 750 was charity care. They paid 850. So there's still, or I'm sorry, what do I want to do here? Let's see, 850 was the patient payment. We disallowed 250 because that was their normal payment. So that gives us 600 that they actually paid compared to the 750 that was charity care. So what we're saying is there's only 150 left as actual charity care, but we don't have any payment that needs to be reported anywhere. So that's what's going on here. But now let's say they paid another 150 in 2022, the next year. We're not going to adjust charges that year, but we are reporting the $150 payment as basically a recovery in line 22 because it was for a prior year write-off. The payment template, again, when you need to send it, it's largely the same as the charity care, only of course now we're focused on the payment. When was it collected? What was the amount? Total hospital charges. Again, we're doing the same thing. We're trying to identify where was that payment related to? What claim was it related to? So when was it originally written off? What year was it actually reported? How much was their patient liability? And how much was actually written off as a bad debt? Because that's another important thing. A payment, before we ever would consider writing it off against charity care, it first would go to bad debt. Take care of the bad debt as a recovery. Next, it would go to any remaining patient liability. And then only if there's something left would it go against charity care as a recovery of sorts. The other thing to note here, the inclusion of both hospital charges and physician professional charges. If you have both of those, we would prorate some of that payment against those two sections. So if it was a 50-50, 50% hospital, 50% physician professional, only half of that payment would make it to line 22 anyways. The other half went against something that was never allowable. I think we've talked about line 24 and 25 quite a bit, but let me stress here with an example. Now we have an actual example to show. Column 2, line 20, had $385,000 of charity care charges. Notice that line 21 is not the same number anymore like it was in our earlier example. That's because down here, the provider in this case has reported that $12,548 of this $385,000 of charges, or let me back up, $12,548 of this total $385,000 amount was charges. The rest of it would have been coinsurance and deductible. So only this $12,548 is reduced by that cost to charge ratio. So basically this line 21 would be the other portion of these amounts plus the 12,548 multiplied by the cost to charge ratio. So for that reason, these numbers are going to be very close. There's just a slight reduction of this amount to get to this ultimate amount. Of course, you're offsetting any payments from line 22 to arrive at the final line 23 amount. And there's more detail about that. Let's see, it's that same thing, line 24, line 25. So now we'll move on to bad debts. And I touched on this quite a bit earlier, but it's both Medicare and non-Medicare. They both have to be net of recoveries. The one kind of unfortunate thing since the beginning of this worksheet is that there's only one column. There's no split for insured versus uninsured. And for that reason, we don't really know, the system doesn't know truly how much of that is uninsured or how much of it is a charge that should be subject to the cost to charge ratio. And that's been CMS has agreed that, hey, there's no information there to do that. What currently happens is that all non-Medicare bad debts are subject to the cost to charge ratio, even though arguably some of those might have been some other insurance company, and therefore they've been a co-insurance or deductible. The response from CMS and the Federal Register is basically that while this might be a weakness in the logic, it's applied across the board to every provider, and it's kind of a zero-sum game that the total pool is there. So if everybody has to follow that same rule, then the end result should approximately be the same anyways for every individual provider. So the point is, all non-Medicare bad debts are reduced by that cost to charge ratio, whereas the Medicare bad debts are not, because we know 100% that's a co-insurance deductible or copay amount. So that's the explanation for that. Again, it's a write-off during the period, not any sort of bad debt expense, not any sort of estimate, and it has to be this period. Again, do not include the physician or professional services. And you cannot have the same amount, the same piece of a claim being written off as both charity care and bad debt. The only situation that might come up, and we've seen it a few times, is let's say something was written off as bad debt initially, but then maybe the patient came up with more documentation to prove that they should be a charity care patient. So maybe that bad debt was reversed in the next year, and at the same time it was written off to charity care. That is a logical explanation, and that would be fine. But what we need to do is see the reversal of the bad debt, or the reversal of one and the inclusion of the other in the same period, which should generally net out to approximately zero. We can't go back and revise the earlier year because that data is probably not being used for as much anymore. So we need to have the reversal this year. So that's what could happen there. The other thing I mentioned is that, and we've seen this a few times, where a provider tries to report their bad debt expense from their financial statement on line 26. That's absolutely not correct. It would be mathematically very coincidental if your true bad debt write-offs exactly equaled your bad debt expense from the financial statements. Just not likely at all. And the reason is, again, one's an expense, one's a write-off. Different times, different amounts. But we do still require a reconciliation to get an idea of the reasonableness of that write-off amount. It's not going to be identical, but they should be at least reasonably close. You know, they shouldn't be off by a factor of 2 or a factor of 3 or some crazy amount like that. They should be fairly close. So here is just one example of a reconciliation we have published in the past. It's an older one, as you can see by the years. There are many different mathematical ways to show why your financial statement bad debt expense is different than your bad debt write-off. And again, they're supposed to be different, but this kind of it walks through the steps of what caused them to be different. So this is one reconciliation you could use. the same. You start with your total charges, you back out patient payments for the entire claim, back out third-party payments. Now you're backing out charity care for the entire history of the claim because we're trying to back into bad debts. You back out contractual allowances and you arrive at bad debts within reason. And again, the total of all of these different components should not exceed your total charges. Now we get to the charity care policy. And actually, before I do this, let me take a look at the questions. Yeah, the one thing I wanted to mention, so even though the S-10 templates were not technically required at the time of submission prior to 10/1/22, we do need to see the data in this type of template. We need all these data elements with the possible exception of those three things I mentioned, the gender, date of birth, and social security number. As long as we still have another patient identification number, we can live with that. But aside from those, we do need to see those elements, and we strongly recommend that that template that we have on our website, that format be used, because it makes it a lot easier for the process. We have the tools that take that data in and allow us to use it for our audit work papers. So if you send us a different type of template, it's going to create a mess there. But in any case, we absolutely need to see all those elements and preferably in that order. So we have that. For line 22 payments, let's see, the charity care amounts would have to be reversed in order for the payment to be applied. Otherwise, the transaction would exceed the total charge on the account. That's a good point. If a payment was accepted, then you basically have both a charity care. Well, no, actually, yeah, it would because it's the history of the charity care. So you'd see that total charity care that included an allowable charity care from maybe last year. You'd also see the payment this year. So you're right. That would lead to a situation where the sum of those components would exceed the total charge. And if that happened, if we got an explanation for it, and if we could pinpoint it, that would be fine. But again, that's an absolutely huge red flag anytime those total components exceed the total charges. But what you've mentioned, if you did not reverse it, that would be an acceptable explanation for that. And let's see, why does CMS continue to ask for insurance status for bad debt when they are not separate, like insured or uninsured columns? Like you said, it's extremely difficult and time consuming to assign insurance status correctly. And that's, I mean, it's a good point. There's no place to put it, but it's still a risk issue. What we look for an insured bad debt is different than what we look for an uninsured bad debt. Again, we're looking for, if it's an insured, we're looking for other payers that have already made payment, and then we're backing into the bad debt. If it's uninsured, we're not expecting to see those. So it really comes from a risk factor of how do we audit that? And that is still different from insured versus uninsured. The difference is we won't know it on the cost report, but we need to know it on the list. And that's why that indicator is required. And Alan, you make a good point here, a good question. You have a separate file for the revenue code charges. Is that still okay? And yes, that is okay. If CMS allowed that, I think the past couple of years, they basically said, first of all, if it's a separate system, we don't even need to see the revenue code breakout at all. But if it's in the same system, we can have two listings. We can have one listing just showing one line per claim, all rolled up to one, and then a separate listing showing the revenue code breakout, and that would be perfectly fine. In fact, that makes our lives easier because the way we do the duplicate check would be a lot simpler. We'd use that roll-up portion, that roll-up listing. The only thing we'd use the revenue code listing for is checking for professional and physician fees. So very good questions there. So the charity care policy piece, I just wanted to mention here, we've talked about this quite a few times, that things are only allowed if they're explicitly stated in your charity care policy. This is part of CMS's required audit steps. It's been there all along, but there was some some issues in the earlier audits where providers just either were vague in the policy, or even in some cases they flat out disallowed something that they were trying to allow later on. So CMS had us remind providers, educate providers about this way back in 2020. We sent reminder letters out at that point. We put out a website article at that point, and then we continued to do management recommendations when we found that there was an error. So the expectation, as with any management recommendation, is that it should be incorporated in the earliest year possible after that notification. We are now, with fiscal years beginning on or after 10/1/21, so we're well after that notification date. And as such, this rule will impact all providers in this current cycle. We really have no justification to not make adjustments anymore if the policies have not been updated, at least by now, to include the fact that, yeah, you're allowing non-covered charges, you're allowing Medicaid length of stay. It must be explicitly stated. And again, that's coming from CMS. They've hit us pretty hard on that in the past. So we have to start making adjustments this year if it hasn't already been adjusted. Now the templates, let me go back to the website because I showed you one piece of it. I showed you the cost report section, which has the bad debt, the dish, all those templates, including S-10. And let me do that one more time here. So with S-10 specifically, there's the pre-10/1/22 template and the YouTube video related to it. And there's the on or after 10/1/22. And oh, by the way, here, I mentioned that there is actually a link to the instructions. I must have put that in at one point. This takes you to Pub 15.2, Section 40. So I just completely forgot I did that years ago. But this will take you to the instructions you need. So this is one place to find the templates for all the different issues. But if you go to, let's see here, I need to go back. If you go down to S-10 specifically, Worksheet S-10 Uncompensated Care, there are two links there. One of them is this whole thing about the charity care. This is what I just talked about, the importance of that. But the other one is the general Worksheet S-10 charity care audits. If you go there, you'll see, first of all, a link to the old final rule that started this, that started these S-10 audits. You'll see a lot of the same breakdown that I've discussed throughout the training. You'll see our resources, the various YouTube videos we have, including our overall YouTube playlist, which has everything S-10 and plenty of other things. And you'll see, again, the breakdown of the various instructions. And here's the template. This is what I was pointing out. This is the template that you should be using for the S-10 audits. And this is actually what we reference in our letters that get sent out. So we have all of that there. That's what I'm trying to get at for that slide. Oh, and I do want to mention one more thing, the query logic. So I want to open that template up. I've got it saved, but it's the exact same thing from that website. And what we have here is, first of all, the instructions. We have all the templates that we just talked about. But then we have the questionnaire itself. Now, we've gone through this in great detail quite a bit in the past, and I've got a YouTube video that goes into it. We have not changed this for a number of years. Well, with one exception, that HRSA issue that we'll talk about. But basically, the whole point of this is to allow for a narrative as to how you search your system to find out that you were only including the write-offs here. If there were any duplicates, anything that looks like a duplicate, like part of the claim was written off last year, part of the claim is written off this year, how did you ensure that that you didn't truly duplicate a total amount? What transaction codes do you use? How do you ensure that something wasn't written off in both the charity care and the bad debt listing, at least in total? Again, partial write-offs for both are fine. And do you have any Medicare in line 20? How do you know they're not Medicare bad debt? Basically, all of the different things we've already talked about. This serves as a reminder as well as a place for you to essentially attest or explain how you know that you didn't violate that rule. That's kind of what it boils down to. There's also down here, there's that example of the reconciliation for bad debts. Feel free to use something else if you like. And it gives you a place for any other explanation you think may be helpful. So that, I just wanted to touch on that query logic. Briefly, the File Exchange is a security EDI portal. It's a new version of what we've used in the past, or years ago, I should say. So again, there's a security protocol that says each auditor that you want to contact has to reach out to you first to set up that initiation. Now, they don't have to do it every single time. They have to do it once, and then it locks that in your address book, so to speak. So if you want to talk to a new auditor, maybe you're dealing with a new auditor for a desk review, if you've never reached out to them before, or if they've never reached out to you before through the system, they'll have to do so. Only the first one needs to set up your password and set up your account. After that, it's just a connection. So we have, the website is https and then FE for file exchange .wpsgha.com. Now I want to also point out on that same website, we have, let me go back a slide here, at the very, or not at the very bottom, under the self-service link. I know that doesn't seem all that intuitive, but we have the secure EDI instructions there. They go through the detail in case you have any questions about that. And here's a screenshot of it. Here's a screenshot of the actual article. You'll see here that there's it definitely is much more beneficial than regular email, and even more beneficial than the old portal we had years ago. First of all, it allows for security, whereas a regular email wouldn't. And it gives a much bigger file size limitation, 2 gigabytes instead of what's generally 20 megabytes for email. There are no file type restrictions. You can, if you want, if you feel safer leaving on the password, that's fine, but you don't really need to because it's a secure portal. Of course, if you send it with a password, you'll have to separately email us the password. The file names will remain intact when the auditor grabs it, so name it whatever you feel is logical. It can be used by contacts other than just the provider, whereas the old portal could not. So you could have consultants or home office staff. Now, there is a limitation on the number of files per email, per message. It can only take 10 files at a time, regardless of the size. So if you want to, you can zip them up. If you have 20 files, you can zip them up into one zip file and you'll be good to go. Even though there are 20 underlying files, it's just one file, one attachment per se. So now we'll get on to some special points here. A lot of these are reminders. The whole duplication of claims on listings. Again, you may very well have the same patient and date of service show up on multiple listings. If you wrote it off, part of the claim was for bad debt, part of the claim was for charity care, or possibly even part of the claim was written off in different periods. But we're going to be looking at the aggregate. We have a tool that we use. We call them complex duplicates. We look for the aggregate of all those listings for that claim, and we make sure that all the charge components across all listings don't exceed the total charges that were there. And again, it takes into consideration, basically it looks at the absolute maximum total charge that ever existed for that claim, and then it takes the max of each of those pieces, except for the bad debt and charity care. It sums all those up, and it makes sure that it has not exceeded that total charge. Now, I didn't want to get too far into the weeds there with how it works technically, but it finds those true duplicates. That's the point. The issue with sampling is, as I said earlier, we prefer to be able to find as many of the errors up front so that we can clean the listing up before we get to the extrapolation. identified that statistical sample, it's too late to go back and resubmit the listing to clean it up. That's the reason we spend so much time up front trying to do that, because anything we do to the sample or the population after we've already sampled it destroys the statistical validity of it, and we'd have to start from scratch. Let's see, we talked about how some of the claims would be split between insured versus uninsured, except for that darn Medicaid length of stay issue. Bad debts, I think we've already talked about. Oh, there's one additional point I want to make here, though. I already explained the potential timing difference between when a Medicare claim could be included in the total bad debt listing versus when it's allowable as a Medicare bad debt. For that reason, or at least partly for that reason, we need a total listing of and have all the same elements we need. So we do need a total bad debt listing with everything, Medicare and non-Medicare. Talked about payments already. This HRSA uninsured provider relief fund payments should not be as much of an issue this year because the fund pretty quickly ran out of funds. That little odd to say it that way, but it did run out of money. That's maybe the best way to put it. Now, the instruction from CMS, though, if a patient was deemed as a HRSA uninsured provider relief fund payment classification there, the problem is when you bill them and when you receive any money from that fund, that's deemed to be payment in full, and it can no longer be counted as charity care or bad debt. So that's what we're looking for. We need that to be identified, and it should have been excluded already. If any payment was received, that's the point. If it was billed but no payment was received, then it's fine as charity care or bad debt. But if payment was received for the same type of service that you're trying to include on your charity care listing, then it's not allowable. And by same type of service, I want to stress, there were three basic things that the fund paid for: COVID testing, COVID vaccine, and just services potentially related to COVID. Now, if let's say you got reimbursed for COVID vaccine or COVID test, but what you're trying to report on your listing is actual services, complications related to COVID, that's a different thing. That could still be allowable as long as you didn't receive any money for that bucket. That's the important piece. Now we're down to about 7 minutes, and I wanted to spend some time talking about the actual new templates that apply to next year, but you're already starting to file these with your cost report whatsoever for charity care or for bad debt, whatever, or dish, and you have it on your cost report. Now, there are other issues, there are other edits where there are certain rules where the system tries to go in and say, well, first of all, the amount doesn't match. It doesn't have to exactly match. There's a little bit of a cushion, but it has to be pretty darn close. So if it's way off, it might spit back an error. Now, in some cases, those things, they don't automatically reject. They go on to the auditor for further review, but they don't automatically accept either. They go on to the auditor for further review. There are other things where maybe the data elements don't seem to be correct. They don't seem to be logical. It'll probably give you a warning, but it might also spit it out to the auditor for further review. So again, a lot of those edits, and it's one of those things that as you go through the process, you'll start to see some of them. When we had discussions with CMS, we tried to limit the number of things that were full-on rejections because there are so many different scenarios that we may not have even discovered yet. So we tried to give the auditor the ability to use judgment instead of a systematic rejection. Now, what I want to point out here, I'm going to open up those new templates first of all. And there are two illogicalities I want to point out, or certainly one is just an important thing to note, I guess. This patient insurance column. Let's go to the total charity care. This is the new listing. There's a new element over here called the insurance status. Now, a lot of this other stuff's the same. Notice the date of birth, gender, and social security number are gone. This insurance status 1, 2, or 3. So let's take a look at the instructions here. It's both for charity care and bad debt. 1 is when it's completely uninsured, no insurance coverage at all. 3 is when there's a full insurance. 2 is kind of the complex situation where maybe it was technically insured, but it wasn't covered because it didn't have a contractual relationship. Maybe they were medically necessary, but that particular service just wasn't covered under that plan. Maybe they've exhausted their benefits, or maybe it was Medicaid and they exhausted their benefits. That's what 2 is all about. It's just basically to let us know that there's probably more risk there, more we need to look at. That's what the 2 status is all about. Now, the other thing I want to point out, the illogicality in the instruction here, again, there are 2 of them. One of them, first of all, note there's a total charge and a physician or professional charge. Now, if you look at total charges, column 9, it says enter the total charges excluding physician or professional charges. But then column 10 says, well, hey, if you did include physician or professional charges up above, despite the clear instruction not to do so, then basically tell us what those were so we can carve them out. It's odd. I really don't know why they did it, but kind of a double check to make sure one way or the other, physician and professional charges are being removed. So that's this piece. A little bit illogical there. But now let's talk about that reconciliation. It's largely the same as it was before. Oh, and by the way, notice revenue codes are gone from the listing as well. So we have total charges for the claim. And then again, we're backing out the different components. We've added in a few more components to this to make it easier to tell where something goes. Third-party payments, insured contractual, other non-allowable. For example, the courtesy discount, basically things that are not allowable, period. Total patient payments, amounts written off as bad debt, because if they're written off as bad debt, they can't be charity care. Those are all the, what I guess, beige columns here. And doing that, charges minus all these things should arrive at the charity care allowable amount, or at least it helps to support it. Now, they've broken into 3 types of charity care. Uninsured discounts, which again have to be included in your policy. Charity care non-covered charges, if your policy allows it. And then other charity care charges, which basically, even though it's kind of a miscellaneous type thing, this really should be the bulk of your charity care to begin with, because these other 2 things are kind of special items. So most of your charity care generally would fall in here. And I would actually say if it's an insured listing, these first 2 columns don't even apply. So all the insured charity care should go here. Column T sums these 3 up. Now notice that's on column 20, which again, that's what you report on line 20 of the cost report. There's a write-off date, and we moved it to the very end to get it out of the way of the numbers. Obviously, it's very important, but we didn't want it to interrupt the numbers when we worked with CMS on this template. Now, the final illogicality that really I think CMS just needs to change in these instructions, notice they have the deductible or co-insurance co-payment amount. For an insured patient, and let's say it's fully insured, this is the only thing that should ever lead to a charity care to begin with, because there won't be you're not going to have a charge that you back out all these things to arrive at some other charity care. All the charity care would have to come from deductible or co-insurance or co-payment amounts. But if you look at the instruction, and let me make sure I'm in the charity care piece, they where is it here? They put it under the payment Yeah, here it is. They reported under column 15, which by itself is illogical because this parenthetical explanation has nothing to do with payments. But they say charity care is determined as column 9 minus 10, all the way 10 through 16, and then it's reported on column 17, 18, or 19. The problem is if you take 9 charges minus 10, 10 makes sense, but if you subtract out 11 and then 12, 13, 14, 15, 16, for an insured patient, that is to kind of clarify that. We hope CMS will update that in the instructions, the actual cost reporting instructions, but we have it clearly labeled in our piece. The other thing I wanted to mention with this template is basically what I said earlier about the SCH not having to file this for the 10/1/22 and after fiscal year begins, but we still have to audit it. They don't have to file it at the cost report submission, but we still have to audit it. So I know we're about a minute after. The only slide I have left is the available resources, which we've already gone through some of these before. Just a reminder that the S-10 letter is it's already been sent, or it's sent out tomorrow. It's going to be sent out. And what I wanted to do, just before I ask for questions, I did want to post a link to the survey we have for this webinar. I sent it out in the email initially, but I wanted to post it in the chat area, so you'll see that under my name here. The one thing I want to stress, though, is I know we have some MAC staff on from WPS, maybe even from other MACs, but no MAC staff should take that survey. It's only for non-MAC staff. So a provider can take it, a consultant can take it, whoever. But we'd certainly appreciate if you could take a few minutes to complete that survey. And now I want to get back to the questions as we wrap things up here. Let's see. We go back here. We have from Debbie, we have a CAW that bills pro fees under method 2. Since the S-10 for this CAW facility is not audited, do we still need to send this by revenue code? And that's a good point. Since we're not going to be auditing it and there's no real reason for that template to have all that data in it, so you won't necessarily need to fill that template out. You should be reporting S-10 properly. I don't want to say ignore the instructions for S-10 for a CAW, but you don't need to worry about it in the template because it's not going to be used for anything. From Nick, do you expect CMS to publish an update to Exhibit 3B and 3C templates to include transaction codes? You bring up a good point. That's one thing that even our auditors have expressed concern about, because that's one of the quick ways we can find if it's truly charity care or not, or if it's truly bad debt or not. And I don't know, I haven't heard about them updating that template. It's one of those things where if it's not in the template, then unfortunately the only way we'd be able to find it would be through statistical testing or detailed testing and statistical extrapolation. So I suppose a provider could always submit additional columns if they wanted to avoid that concern. But as far as a mandate, it's not there at this point, and I haven't heard of them planning to change it in the near future. So good question. And let's see. Yeah, so the whole required piece, what I want to mention there, those instructions you're looking at are for the MECREF system. And the reason some of them are not required is that not every line would have to have that column. For example, an uninsured patient, it would not have to have coinsurance and deductible. So what you're looking at is actually a system document that CGI used to program MECREF, and we instructed them on which ones you need to basically reject or at least warn about if a cell was not filled out. But the ones that are not required, that doesn't mean not required at all ever. It means it's not required for every single line. It's dependent upon the situation. So that is that's the issue there. It's still required if you have certain types of patients. So that hopefully will help to clarify that piece. And let's see, we already talked about that one. And a merger, that's a good question. What about a merger? Does the old decertified number need to be audited? At this point, the instruction has just been that if that number does not exist anymore, that we don't need to audit it. But you do bring up a good point. Behind the scenes, what is CMS truly using for the S-10 data? And they haven't really been transparent to us about it. So it's a good question we can raise with them. But right now, we know if the provider has been terminated, we don't actually use that, or we don't actually audit that. But you do bring up a good question. I'll add that to my list to get with CMS on. So with that, are there any further questions on the S-10 process or anything else? Okay, well, I just wanted to thank you all for your time. This has been recorded. I will be posting it to our YouTube YouTube page later, and I'll send out the email to everybody with the attachments again and the YouTube link. So thank you again for your time. I hope this has been informational for you, and I hope everybody has a great rest of the day. Thanks.